Where are interest rates heading, and why doesn't Miami seem to care? Welcome to the Market Movers, the podcast where we break down the complex economic forces shaping our world. I'm your host, Luis Fernandez of the LRF Group. The question on everyone's mind, from Wall Street to Main Street, is simple. Where are the interest rates heading? By June 2026, we'll see rates go up or down. And more importantly, what does that mean for your biggest investment, your home? Today, we're diving deep into the U.S. real estate market, but with a very specific focus. We're heading down to South Florida, to a market that seems to play by its own rules, Miami-Dade County. While the rest of the country holds its breath with every Fed meeting, Miami's market is dancing to a different beat. We'll explore why and what it means for buyers and sellers in this unique, sun-drenched metropolis. First, let's set the stage, the national stage. As of early of 2026, the Federal Reserve has been navigating a complex economic landscape. After a series of aggressive hikes to combat inflation, we've seen a period of stabilizations with the federal funds rate hovering in the 3.5 to 3.75% range. So what's the forecast for June? Frankly, the experts are divided. On one hand, you have a major institution like JP Morgan predicting the Fed will hold rates steady through all of 2026, with the next move potentially being a hike in 2027. They point to a stabilizing labor market and stubborn inflation as reasons to hold the line. On the other hand, forecasters at Bankrate are projecting up to 3 small rate cuts later this year. The market itself is betting on a sideways to slightly down trajectory. The consensus: don't expect any dramatic drops. We're likely looking at a high rate environment for the foreseeable future. But there's a wild card in this equation. President Trump's nominee for the next Federal Reserve chair is Kevin Warsh. Warsh is set to replace Jerome Powell when his term ends in May 2026. Now, Warsh has a history as a Fed governor from 2006 to 2011, and back then, he was known for favoring higher rates for longer, particularly after the financial crisis. But here's where it gets interesting. His recent comments suggest a much more dovish stance, one that aligns with the administration's preference for lower rates. Many economists believe that in his first year as chair, Warsh will make the case for rate cuts. However, there's skepticism about how long this dovish approach will last. Some predict he may revert to a more hawkish view as time goes on, particularly after the midterm elections. The bottom line: Warsh's nomination adds uncertainty, but it also tilts the odds slightly toward a more accommodative monetary policy in the nearer term. For a typical real estate market, this has a clear impact. Higher rates means higher mortgage payments, which pushes potential buyers out of the market. This reduced demand usually forces sellers to lower prices to compete for a smaller pool of qualified buyers. A 1-point percentage drop in the mortgage rate can bring over 5 million new households into the market nationally. So for the most of the country, the Fed decisions are paramount. But Miami-Dade isn't most of the country. So what makes Miami so different? The answer can be summed up in one word: cash. While buyers in other cities are anxiously calculating their debt-to-income ratios, a stunning portion of Miami's transactions are happening completely outside of the mortgage system. Let's look at the numbers because they are truly staggering. In the Miami Metro, for home prices between $1 and $5 million, over 53% of sales are cash. For home over $10 million, that number jumps to nearly 60%. And in the ultra prime new condo market, an incredible 83% of sales are all cash. As one analyst puts it, bubbles are not built on cash, they are built on debt. Miami is being propelled by cash. This creates an incredibly firm floor for the market. While the rest of the country is sensitive to a quarter-point rate hike, Miami's luxury market barely flinches. These are the Uber buyers you hear about, the high net worth individuals and billionaires for whom a mortgage is an option, not a necessity. This cash dominance gives sellers immense confidence. In markets like New York or Los Angeles, where a home sits, the price drops. In Miami, Sellers are more likely to simply pull the listing off the market and wait. They know their target buyer isn't worried about the cost of borrowing. They're worried about finding the right property. Where's all this cash coming from? This brings us to the second factor that defines the Miami market. Its role as a global gateway and a safe haven for wealth. Miami's feeders market are a potent mix of domestic and international capital. Internationally, Latin America has always been a primary driver. Buyers from countries like Colombia, facing political or economic instability at home, see Miami real estate as a secure place to park their wealth. In 2025, international buyers poured $4.4 billion into the South Florida real estate, a 42% increase from the year before. Foreign buyers now account for 15% of all home sales in Miami, a figure that is 7 times the national average. But it's not just foreign capital. A massive wave of domestic wealth migration is also fueling the boom. High net worth individuals are leaving high tax states like California and New York, facing potential new wealth. Tax billionaires like Google's co-founder and Palantir's Peter Thiel have been securing a presence in Florida, drawn by the state 0% income tax and the business-friendly environment. As one expert noted, when jurisdiction goes left, money flows to Miami. This influx has created a tale of two markets. At the top, the ultra-luxury segment is shattering records, and in 2025, the region saw the second highest number of $10 million plus home sales in its history. Neighborhoods like Fisher Island have become the priciest zip codes in America. Yet for the average local residents, this boom has created a significant affordability challenges, pushing homeownership further out of reach. So let's bring it all together. What does this mean for buyers and sellers in Miami-Dade through June 2026? For sellers, particularly in the luxury, ultra-luxury tiers, the market remains incredibly strong. You are not beholden to interest rate fluctuations. Your buyers are global. They're wealthy and they're paying in cash. You have the leverage to hold your price, and the data shows that that's exactly what you're doing. For buyers, the picture is more complex. If you're a finance buyer, you're at a distinct disadvantage, competing against cash offers that can close quickly and without contingencies. The market is bifurcated. You may find opportunities in the resale condo market where prices have softened slightly, but if you're looking for a single-family home in a desirable neighborhood, you're in a seller's market and you'll need to be prepared for a battle. In conclusion, where are the interest rates heading by June 1st of 2026? The most likely answer is sideways, with a slight possibility of a minor dip. This would bring some relief to housing markets across the United States. But in Miami-Dade, the story isn't about interest rates. It's about cash. It's about wealth migration. It's about its unique status as a global hub, insulated from the credit cycles that govern the rest of the country. While a slight dip in rates might help a few local buyers at the margins, the fundamental trajectory of the Miami market will continue to be driven by the powerful flow of global capital, making it a fascinating and formidable place to buy or sell a home. Well, that's all the time we have for today on the Market Movers. Join us next time as we continue to explore the forces that shape our economy. I'm Luis Fernandez with the LRF Group, and thanks for listening. All the very best.